Financial Partners clients. Jeff Mathis here. I hope you all are doing well. If you are like many, you are probably watching the news and seeing what's happening in the world markets and scratching your head a little bit. This coronavirus is definitely affecting some things, and it's getting very interesting to say the least. I would first like to say thank you all for the comments and the understanding of how markets work. For those of you who've been with us a long time, I have enjoyed talking to you and getting some feedback from you and hearing that the coaching that we have provided for the last umpteen years has worked really well. You're saying all the right things. Even for our newer investors who haven't been through a large amount of market volatility like what we are experiencing now, you're still asking lots of very good questions and you're staying disciplined, and I'm very proud of you for that. What you are about to witness in our markets is the largest transfer of wealth we have ever seen, in my opinion. We've never had markets with volatility moving the way it is, and this is not necessarily a bad thing. So what I want to do is I want to share with you exactly how this works when it comes to rebalancing, when it comes to markets, and certain other factors. And I'm going to draw some things up for you that I think will help visually help you understand what it is we do when we have crazy volatility like what we have seen in the recent market movements. And I want to make sure everybody is on the same page that this is not necessarily a bad thing. The only time this becomes a nasty affair is if your portfolios are not designed to handle turbulence. All of yours are. So let me begin. When you're watching so much negativity in the world, it's important to just get a refresher about how some of this stuff works. So I wanted to take a couple of minutes in this quick video, and you'll be getting more of these as things continue to be volatile in the markets. We'll continue to update you, but just a couple of things I want to point out that I think will help, and I want you to share these with your friends and family. There's a lot of people out there who are scared, and you're probably speaking to them. So it's sometimes you become the coach. I know for a long time you've all been students of ours. Well, now may be the time that you can help other people with what you've learned. So let me show you how markets generally tend to fold when it comes to the types of investors we have. So first, there are three types of investors that put money in the market. If you look at it from a 10,000 foot view, you've got these guys down here. These are the folks that just don't really care what happens. They don't pay attention to it. Maybe they inherited some money, whatever it may be. They're not in, they're not out. They're just there. They may not even open their statements for years. They just sit there. Then you've got a big group of people here. These are your more avid investors. These are the people who have a plan. They are disciplined. They either understand how markets work, or they at least understand the rules of investing and what you do when markets are going up and what you do when markets are going down. These are where our clients fall. This is us right here. Then you have the folks at the top of this. These were we call these drive-by investors. They're people, they don't understand how markets work. They don't really want to learn. They just want to put their money in with the hope and dream that it's going to skyrocket. They're going to make a bunch of money, but they don't understand the internal workings of the market. What happens is they invested based on fear, they invested based on greed, but when it flips around and things get a little crazy like they are right now, the fear emotion sets in and they panic and they start selling everything they've got. They're trying to move to cash. They do the exact opposite of what you're supposed to do, and they run for the hills. Now, here's what happens. This is the wrong place to invest. This is not us. But inevitably, what happens is those of us who are in the disciplined category, we will end up getting return from all of the sales here, all these people who are liquidating, running for the hills. The folks down here who are disciplined end up profiting from the dysfunctional behavior of the investors up here who are selling and running away. And here's what I mean by that. Your portfolio is designed to handle this type of turbulence through rebalancing. And rebalancing works a little different for different types of investors based on money in, money out. Are you receiving payments? Is there an unusual type of a circumstance? So I want to draw a couple of things out for you to explain what it looks like. Rebalancing is based off of certain thresholds. So let's assume that this line right here represents your base. There's these parameters on the top and parameters on the bottom that if the market is not, if it's falling within these parameters here, nothing happens. If, however, it jumps up and you have a massive amount of growth, it will be rebalanced and these profits will be captured. If you have a crash and it falls below this particular threshold, we will rebalance and we will buy all of this stuff that's on sale from the fall. So to give you a little better understanding of what it looks like, think of it like a seesaw. So this could, on the right side of this seesaw over here, this could be fixed income or equities, and the same on the other side over here, fixed income or equities. When you have one asset class that jumps, you usually have asset classes that have dissimilar price movements. So when you have one that jumps, you have others that are doing something else. And the goal of rebalancing, when it's outside of the parameters, you take what profits were made and you buy stuff that's on sale. Because history has shown us that what goes up will come down, what goes down will come up. So when this side now jumps and these other dissimilar price movements are going down, you will then take what's jumped and you will buy what's on sale. This is how you're capturing profits and buying what's on sale all the time. It's the rules of investing. You sell what's up and you buy what's down because we know it's going to swing the other way. Now, right now, everything is on sale. Right? So what happens when you have a cycle that your equity positions are on sale? Well, you look at your fixed bucket and you look and you say, okay, now we're way out of whack, so we're going to take money from the fixed bucket and we're going to buy everything down here that's on sale that we can get our hands on. Because disciplined investors know that when you have these market crashes like what we're experiencing right now, this sheer amount of volatility in such a short period of time, the rebounds are lightning fast. The recoveries are lightning fast. Rush Limbaugh was talking about it today. The big banks are talking about it. They're already licking their chops because the fall has been so quick. They know that it's a matter of time before it levels off, and they will be buying everything they can get their hands on. And our expectation is that this thing is going to skyrocket. So prepare for liftoff. Your portfolios need to be prepared for it. You need to be prepared for it. The recoveries are usually lightning fast in these types of situations. The average market crash only lasts 111 days. That's not a very big window of time. And I want to show you a chart that was shared with me to give you a little better understanding of what that actually looks like. So this particular chart represents the S&P 500 going back 20 years. The orange line here is where it actually ended up. So for example, in 1980, the S&P ended up from beginning to end plus 33%. But what people forget quickly is some point in that year, the market was actually negative 10. And what this chart shows you is there has not been a period of time, there's not been a year in 20 years where there was not a down point in time in the market at some point. And let's look at the periods of time where the market actually ended down, like this one. We all remember 2008. That was a painful year. The next year we had negatives, all through here negatives. But look at what the positives were where it actually ended. They were high. This is great news because what that means is if we have a market crash and it ends down, we actually end the year down. Usually the years following that are great years for investors. So what you don't want to do is get caught selling your portfolio, blowing it up at the bottom, because we understand how markets work. These recoveries are very fast. Now, 4 things to take away. Number 1, rebalancing is designed to capture profits and buy what's on sale. That's number 1. Number 2, again, the recoveries to these flash crashes are usually lightning fast, but you got to be in it to get it. So do not blow up your portfolios. And again, we're proud of all of our investors for staying in there, staying disciplined. If you have questions, please call your coach. Number three, I want you to remember this will happen again. This is how the market works. This is the part of it that a lot of people are unprepared for. It will happen again, and we will be prepared for it. The portfolios are designed to handle turbulence like this. And last thing, for those of you who are calling wanting to put more money in, we appreciate it. We're getting a lot of inquiries for this. Make sure you contact your coach directly and have a discussion about what the goal is for that money. We don't want to get caught market timing, but we also understand that one of the rules of investing is buy when things are low, buy when they're on sale. So I appreciate the phone calls, but make sure you reach out directly to your coach about the new monies that you're wanting to move in. Ladies and gentlemen, if you have any questions, concerns, or fears, don't set on that. Call your coach. That's what we are here for, and we'll get through this together. Thank you so much. We will talk to you again very, very soon.